All right, folks, welcome back to the Property Couch podcast. We have got a big show today. It is Q&A day. We are going to hear from the people, Ben. We're going to hear questions like, can you pass on interest rate rises to your tenants? Can you also update your property plan, Ben? Good questions. What do you got?
I've got interest rates and how they potentially affect long-term growth, Bryce. And we've also got a great question from Karen around restructuring strategy and structure of your mortgages.
Very good. Big show, Ben. I'm a bit nervous about your voice. Hope you can hang in right till the end, but let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holloway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch. Hello, mate. How are you?
G'day, bud. How you going?
I'm very good. 3 guests in 3 weeks, Ben. It's been a big lineup.
Yeah, it has. We've had some
Eleanor Cray, the Honourable Dom Perrottet, then we had Tim Lawless. That's a pretty good trio, wouldn't you?
Yeah. Well, I mean, you know, anyone who wants to come on who's got a message, reach out to us.
Yes.
We'll see if you've got a good story to tell.
Let's qualify that. If there's value to be added to the community, Ben, we get lots of reach outs where there's no value added to the community. So I have to flat bat those. But yeah, if you've got some value to add, we would love to hear from you. Hey, but Ben, what better pivot than today when we get to hear from the people? We get to hear voices from our listeners.
Yeah, love it.
Amazing questions. The good news is for anyone who asks us a question on SpeakPipe and we play it out on the podcast, Ben, we give them a prize. The prize is you get a free start and build course. So if you hear your name today, make sure that you reach out to us. But Ben, we're kind of in that little dead spot where footy's over, cricket's about to start. You don't love cricket. If you're into horse racing, we're getting close to the horse racing season. So we might keep the banter a little light today and move straight on to it.
I reckon let's get straight into it. I've got nothing further to add.
Most of our listeners have gone, oh my gosh, I cannot wait for this little October gap where they just do not bang about on anything other than property finance and money management. So, all right, my Mindset Minute theme today is from, I like to say, our friend on the couch, Ben, James Clear. He's been on the couch. For those people who have missed that, it's episode 261, How to Hack Your Habits to Make You a Better Money Manager. And you and I were talking about James the other day. We probably landed him at the sweet spot of Atomic Habits. He came over to Australia and spoke at ARIC, Australian Real Estate Conference, early days in the book release. So when we reached out to him, said, do you want to come on the podcast? He said, sure. I mean, imagine trying to get him now.
Well, his book globally has sort of been in the top 10 best-selling books around the world for almost 2 years now. So, I think you're right there in terms of that.
So he says, simple mindset shifts. I'm not hurt. I'm healing. I'm not losing. I'm learning. I was not rejected. I was redirected. So good things to think about, man. But then he goes on to say, negative things happen. Negative mindsets make them harder. It's like,
oh, yes.
And it kind of remembered me the very first tape, Ben. I had one of those little cassette tapes. It was How to Be a Winner by Zig Ziglar. I put it in my little Mazda 323 that I was fanging around in at uni, where the air conditioning was going 60 k's an hour with all 4 windows down, because, you know, when you're at uni, you can't afford air conditioning. So I had this little tape, this little mindset tape that I put in there. And Zig Ziglar said, positive thinking isn't the answer, because he goes, no matter how positive I think, I would never be able to whip a boxing champion. So, Ben, no matter how positive you and I think, we're never going to win an AFL premiership in our lifetime. No. So, but what he did pivot to say is he goes, but you can do everything better with positive thinking than you can with negative thinking. I thought, oh, that's a really ripper shift. So James Clear is tapping into that here as well. So negative things happen, negative mindsets make them harder. So, folks, think about what stories you're telling. Think about what happens to you and how you can make that actually optimistic despite the fact that in the circumstances it looks negative. So
love it.
There you go, something for you to lead into the weekend, Ben, as we go into Q&A day today. But just a reminder that anyone who hears their question read out, they will get a free course. So you ready to rip in, Ben?
Let's get started, Bryce.
First question is from Janet. She has got a question, Ben, about when should you actually update your plan?
Hi, Ben and Bryce. My husband and I are big fans of your podcast. We have learned so much listening to the both of you over the years. We've actually been to your team Empower Wealth in North Melbourne for financial planning and property investment advice. That was before we went on our honeymoon. Now we are one child, 14 months old, and 2 properties in, 1 principal place of residence and 1 investment. This were all factored in by your team as part of our Lifestyle by Design plan. There's a component to the plan, which is to get our 3rd property in a few years' time as investment to work towards our retirement plan. However, with the changing market, I'm starting to wonder if it's time to bring things forward or stick to the plan. So I guess my question is, once you've got a property investment and a retirement plan set up, how often would you recommend getting this revised and looked into? I would love to hear from the 2 of you, and keep up the good work with the podcast.
Janet, thank you for that. But Ben, stick to the plan or bring it forward? Good question.
Oh, look, and a shout out also to Janet in terms of, sort of taking action and actually following that action. That's the biggest steps are being made. So good on you, Janet, and also your husband there around doing that. It's relatively easy to answer this question. So if there is a material change to your circumstances, that should trigger the opportunity to review your roadmap. Okay, so if you think about, the analogy we use about driving to a destination, if there's a significant detour or potentially a speedway in which you can get on to get to that destination sooner, they are the types of triggers that would happen. So in Janet's case, it appears that their financial position is stronger than what maybe the conservative model that we built at that time. And the idea of bringing that forward makes a lot of sense to me, because ultimately we've always talked about, Bryce, about time in the market, and certainly buying an asset in these uncertain times with a long-term view makes complete sense. So that's how I'd summarize it. I'd simply say that if you're looking to your plan and you're only sort of 3 to 5%, sticking to that plan, probably keep going. But if there is a material windfall or something that's happened, and some of these sometimes are things like inheritance and also promotions and those types of things as well, or change your mind around having, sort of 2 kids instead of 3 children, or whatever that may mean, they are material differences, and that's where you can potentially bring those plans forward. Another great one, Bryce, that I can think of as well is one of the great things about having a plan, and in our plans, we have these 36-month cash flow forecasts, and they are really great at trying to challenge yourself and gamify getting in front of that potential amount that you would have in, say, offsets and savings. And so from our point of view, if you are 10% in front of that, then absolutely you should be bringing your strategy forward, because the earlier you bring it forward, if you think about our 4 levers, income, expenditure, time, and target, guess what? If you're bringing the expenditure down and you're actioning on those investments earlier and they perform over the long term like we hope they will, then you've also brought that retirement option forward. You don't have to retire, but you're potentially bringing that option forward.
Well said, mate. You said material change. The second one for me, and you've said it, is the outperform result. So we've had a bunch of people that have gone through just because you're right, with conservative estimates and growth targets on these properties, but then you may have a period of time like we've just experienced through the pandemic where the performance of the asset is grown well in excess of expectation and plan, which means that you have an opportunity to leverage a little earlier to go forward. So if you remember our 5 steps, number 1 is plan, number 2 is evaluate, number 1 is clarify, number 2 is evaluate, number 3 is plan, Number 4 is implement, and number 5 is manage. Janet's done the first 4, but it's the manage, which is the tweaks, right? That's why the manage is there. You come back and you check in and you see, and if everything's fine, go again next year, and that's no problem. But you remember the analogy of the rocket, when the rocket's taking off from towards outer space. Generally speaking, it's only on track 3% of the time, and the remaining 97% of the time, you've got to just make subtle tweaks. So you know which direction you're heading, and it's still going in the general right direction, but it's those little tweaks along the way that give you the opportunity to make sure you still get to your destination, you get to it in the most optimal way. So Janet, it largely comes down to, if you have had an outperform result and it isn't within your risk profile, and you do have an opportunity to still have an appropriate buffer, well, then you may want to bring it forward. Because if you go back and listen to all of our podcast episodes around time, if you can actually lock the asset in earlier, and given there's a sentiment right now, Ben, which is very opportunistic for people that see the opportunity, right? Because, competition is as low as it's been for some time. I'm with you. So material change in your circumstances or an outperform result. Otherwise, generally speaking, as Ben said, the 36-month cash flow should serve you for that 36 months, given that there's no material changes. So good question there from Janet, Ben.
Yeah, I love the question. And if I think about referencing it to our 7 grades of financial wellbeing, Janet and her husband are in financial control.
100%.
And they are looking like, in terms of our downloadable fact sheet here, it also says that, they're focusing on building wealthier tomorrows. So I love that story because, grade 6 is financial peace. So yes, no, it's a really, really good outcome here. So congratulations for them for taking action. It's the most important thing to do. And then when you're taking action, you're adjusting that action. But you've got a roadmap to where you want to be. And lifestyle by design, it's great. Mate, I don't know whether my voice is going to
I was about to say, mate, I've got 4 questions lined up here, and you're almost out on the first one. You good? You need I've
got some water here, but we'll keep going. I just get excited, Bryce. Yeah. I get excited. Yeah. So maybe if I slow down and not get as excited, and put people to sleep, maybe my voice.
It actually does work. If you slow down, mate. So we'll see how we go. The next question. Janet, good one. The answer is keep tweaking. It will serve its purpose for as long as it needs to serve its purpose, unless there's a material change or you've had an outperform result, and then you can update and tweak. Good one. Next one is from Adam Ben. And this one is largely around, can you pass on interest rate rises to the tenants to help absorb the cost? Let's have a little listen to this question.
Hey boys, love the show, and thanks for all the tips and all the advice that you provide each week. My wife and I have 3 investment properties, and given the market is a bit softening at the moment and there's a lot of uncertainty out there, we think it's a really good time to try to buy again. So we can get a loan at the moment. Our brokers confirmed for us that we can borrow at the moment. However, when I run our numbers next year, in about 12 months' time, our 3 properties that we do have at the moment are all currently on fixed rates, and we fixed them at about 2% interest, and all 3 come off their fixed periods in about 12 months' time. So if we did buy again now, buy 4th place, when the loan repayments go up on the other 3 next year at the end of the fixed period, that's more than, I think it's over $2,000 a month extra in mortgage repayments we'll be up for. So we'll be in trouble if we borrow again right now. So we've hit a bit of a snag. Just sort of curious on your thoughts. I think you've mentioned before on your show that in the Australian economy, I think there's about $40 billion in residential loans that are fixed at the moment at really low interest rates from the last few years. And they're all going to be coming off those fixed periods next year. So there's going to be a lot of people, a lot of households all of a sudden have to find material amounts of money each month in extra loan repayments. For those who are investors like us, I mean, we're going to just want to try to pass on a lot of those costs to our tenants and raise the rent that they're paying. So given there already is a rental crisis across the country, how do you see this playing out in the economy? So if you've got a lot of landlords all of a sudden wanting to put the rent up substantially because of the interest rates have gone up and loan repayments are higher, do you think we'll be able to recover some of these costs through increasing the rent at all?
recovering costs through rental increases, Ben? It's a question that's probably on investors' minds for the first time in a while, because if you've been in an environment where interest rates have been dropping for some time, almost to the point where it was at free money, you kind of had this philanthropic view towards your tenants, because you kind of would probably delay the increasing of rents. But now that it's going the other way, there is conversations, if at the very least in people's heads all over the country, thinking the same thing that we've got here from Adam. What are your thoughts?
Yeah, there's a lot going on here, Adam, and I think there's some sensitivity around this type of question, because I think you're right. I think what we did see for the last 3 or so years is that landlords on the whole have been pretty sensible about how they've looked after their tenants, and when the cost of money was going down, there wasn't that need to put pressure on rents. That has obviously now changed. And I also need to correct our community. I did say $40 billion worth of fixed rate loans. It's actually $250 billion worth of fixed interest rate loans. The first tranche is happening really around now. The second tranche is going to be big tranches we're talking about is going to be around the middle of next year. And then the third tranche is going to be around this time at the end of next year. So there is a lot going on in that mortgage space. And, to Adam's point, when our costs do go up and we're seeing record low vacancy rates, it does allow us to look at, the rents that we're charging. Now, please make no mistake that this is going to get political. And so we already know in certain states and territories, they have minimum standards around how often you can increase your rents in those states. So a lot of them potentially have, rules and regulations that you can't increase your rents inside every 6 months. And then there's also potentially going to be contested rental increases that might also find their way into tribunals and so forth as well, especially here in Victoria. Again, with all of that reform we had, very, very difficult. But the market is the market. And I think the important point here is that if these costs are being incurred, then more generally, you are going to see rents go higher. And that's obviously not great for those tenants who are potentially looking to save for their first home or whatever they're doing. I mean, every tenant situation is different. So that is going to be a pain point. But the reality is that, rents are going to go up. We've been saying this now for a good sort of 12 months, that the market was going to see that happening. We've got to remember also over the last decade that rents haven't kept up with inflation. So we've had around 13% growth in rents since 2012 nationally, versus inflation running at around 26%. So we are definitely playing catch up when it comes to those rents.
And it also speaks to the land tax argument too that we had previously, Ben, because the whole idea around why that wasn't a good idea is because if there was an extra cost, the landlords are going to pass it on. Well, here's actually a real direct cost that is actually happening. And so you can start to see the conversations that are happening in one investor's mind, which will be across a whole bunch of investors' minds as well. Now, there's a couple of things to think about here. Supply and demand is well and truly in the favour of the landlord here for the reason why this question's coming up, because there is a rental crisis. So, there is definitely going to be pressure going up. But the other thing to think about too is to help offset those costs, there are tax rebates, right? So if you go back to the basics of negative gearing, what happens is you have an income that's fixed, you have an expense that increases. So your on-paper loss, your taxable loss is larger, and then you put that against your existing income, which means that you can go and get a rebate. So let's just assume 37 cents in the dollar, Ben. So for every extra dollar of interest that you're paying, you're getting a 37 cent subsidy from the government, right? That's why we talk about 3 types of debt. There's horrible debt, tolerable debt, and productive debt. And buying investment properties means that you're getting productive debt. So it's always good to remember that our costs are increasing, sure, which as the homeowner, you are the only person who is paying for the extra dollar in interest. There's no subsidy. Whereas as the investor, you do get that subsidy. It's 1. 2, at some point in time, in line with legislation allowing you you will have those rental rising. So you'll get a little bit of that back, and then obviously you'll be absorbing a little bit more over time as well. But we have been in a very good paddock for some time. So that's that. So rental agreements, they're going to decide. You cannot just obviously put up your rent. So that's number one by default. Number two, the supply and demand conditions suggest that if all things being equal, you're in a position to put the rents up, there's likely that you will. And number three, you'll get some rebate help by nature of the fact that you are a property investor. If I go back to the very first epiphany for me, Ben, was Jan Summers on a whiteboard talking to Ray Martin on the midday show, and her statement was the tenant and the taxman pay most, if not all, of the bills. Well, then that sort of that discussion starts to come into play here again. So sure, you've got for every dollar, you're not getting it all back, but there are a couple of ways that you will start to subsidize that extra dollar that that multiple of a dollar that you have to pay in terms of the interest that's coming into your portfolio.
So when we start to also think about the contractual obligations that we've got and the legislation around those contractual obligations in each state, we mentioned before with the reforms that we saw down here in Victoria, the 133 changes. One of those changes was around, in terms of no grounds. So in that first term, you're able to terminate. And so what a lot of investors might be thinking about in different states and territories is, I might only do 6-month terms because my costs are going up, but I can't pass on all of that in the first 6 months. So I might do a 6-month increase now and then a 6-month increase later. Well, that's all in the contractual relationships. Now, if you're on a month-to-month agreement with your tenant, then of course those conversations will be had by your property manager. But just be mindful in Victoria that under the silly legislation we have down here is that after that first term, effectively you have no grounds, and they could potentially stay in that property forever. And in terms of then the rental increases that you want to put up, you can definitely see that there's going to be a lot of pressure in them potentially disputing that and then having to get an independent umpire to come out and do those. And what we don't know, in terms of the way in which data is presented for rentals, is asking rents are they're the only visual data we see on the real estate portals. What we don't see that's happening potentially behind the scenes is negotiations that are going on between existing landlords and existing tenants. They're not hitting the asking rents pages. So ultimately, if there is a government body that's going to be investigating what is the appropriate rent in that particular market, that they are going to hopefully do the right research and also be talking to the property managers in that location rather than just having a look at asking rents. But so there is a lot of moving parts here. And if I could also say something, Bryce, about, again, we always like to look at the longer term duration of where rents eventually live and where interest rates live. And if you think about it over the long term, and this is just a broad rule of thumb, don't come back to me and say, oh, this isn't the case at this moment in time, or this didn't happen in this, but here's a good rule of thumb. It's usually around a 2% differential in our big city markets between the interest rate that you pay and the yield that you get on that property. So if you think about it, if interest rates were, say, 7%, usually you're getting 5%. If interest rates were 5%, usually you're getting yields of 3%. That's sort of where the market eventually finds its position back to where it is. And again, it's a very rough instrument. It's a rough rule of thumb because there are periods, but we're going through that phase now. Like if I think back into the early 2000s, that first day, it was very consistent. If I think back into the 1990s, it was very consistent. Mm-hmm. It's only sort of been in the last 15 to 20 years. But I feel like we're going to go back to that sort of layer in terms of that 2% differential between your costs and then what you're recouping in terms of the yield. So it's a natural flow, right? Because we're sitting here as investors going, I need to put my rents up because my costs are going up. So it is definitely a pull type market mechanism that is pulling up those rents because our costs are going up.
And how's Adam looking over the horizon too, Ben? Because they started the question by saying I've got 3 investment properties and I can buy a 4th. So in a spontaneous act of let's act on that borrowing capacity, could go and buy another one, but it's kind of really gone, well, but we're at incredibly low rates, and they're about to come out in 12 months' time. And I guess that's probably the criticism of a number of people who went through the last part of the growth cycle that we just went through, where it's just like, well, we're at 0.1%, money's cheap, prices are rising, we just get in. And now all of a sudden they're looking at their budgets going, wow, we are in some pain here because they haven't looked over the hill or around the corner. And I think that's something that Adam's done well. Not only has he been able to delay that need to act on that borrowing capacity, but is also thinking, well, how am I actually going to recoup some of these costs, and what does that mean for my budget? So I'm sure they're having conversations around buffer. They're having conversations around how long will this last? How are they having conversations around actually when would I act on this extra borrowing capacity? So I think these are really good questions that Adam is asking, and I think everyone should be reflecting the same way, Ben.
Yeah, I think if you go through the whole question with Adam, he's answered his own question at the end to sort of say, probably not a good idea, right, guys? In terms of from a cash flow point of view, I'm going to be really stretched. Now, just a shout out to anyone who wants to do this modeling, if I can, if you go onto the Moorr platform and you go into MoneySTRETCH, we've tweaked MoneySTRETCH to be even more sophisticated in terms of being able to do that modeling. So it really does show you the impact in real time in terms of what happens to cash flow. So if you're in a situation where, for whatever reason, you're planning ahead or there's going to be future impacts on income and or expenditure, in the past it was just an expenditure hit that we had in there. Now we've built it in for income and expenditure. So it's really, really good. Sorry, other way around. It was sort of income led and we couldn't really adjust many of the expenditures. So we've tweaked it to basically MoneySTRETCH 2.0, and that is now live. So if you want to go in there and have a play around with your financial numbers, it's a great sandpit to actually see how long your money is going to last you. And I think if Adam was to jump in there, put his future repayments in there, he's going to go, whoa. And that should be the catalyst, because we wouldn't be recommending as conservative advisors that Adam would grab number 4 just yet until we see where basically interest rates are going to level out.
So you go to moorr.com.au, you can get that, Ben, MOOR, or you can go to makemoneysimple.com.au, download our free book, so you've got the instruction manual on how to do that. And then as part of that download process, we'll walk you through the opportunity to get the Moorr app as well. But Ben, it's free. Now is more important. I mean, we've been talking about downloading our Money Smart system during the good times. I mean, and people have been doing that in thousands. But people should be doing it in tens of thousands right now, because it sort of helps you sharpen up and get really clear. And as you say, Money Smarts, Money Fit, and MoneySTRETCH allows you to help with questions like what Adam's asking, which is basically saying, how do I manage money in my household to make sure I don't run out, is really the summary of that question. So good one, Adam. We love it. Next one is from Michael. Ben, this one's about interest rates, borrowing capacities, and long-term impact on price growth. What's this all about? Let's have a listen.
G'day, Ben, Bryce. Hope you're both well. Ben, condolences on the loss to Sydney, mate. I know that's probably a tough one. My question to you both is regarding the overall pricing of housing. I know it's quite a broad question, but with regards to the correlation between interest rates and the impact it has on our borrowing capacity. I know there's been peaks and troughs over the last 20 to 30 years, but we've seen over time, a gradual decrease in the amount that we pay on interest rates. Therefore, our borrowing capacity is increased. My question to you is, now that we've sort of reached that bottom point and we're on our way up, do you foresee that having a long-term impact on the increase in housing value? I know there's other factors in play, but as far as borrowing capacity goes, I can see that there is quite a strong link between interest rates and the borrowing capacity. Just curious to get your thoughts on that and what sort of impact it'll have. Thanks.
Great question, Michael. Ben, the perennial question that comes up where people go, I can see in the rear view mirror that property prices have gone up in value, but surely, as I look out the windscreen, surely it won't happen again in the future. I've been saying it for decades.
Yeah, I love this question, Michael, because it sort of, if I think about our first 20 episodes that we ever did, we really unpacked this in a way that articulated why property prices have done so well in terms of the rising tide right across the nation. And most of it has to do with the cost of money. Because when you think about how money operates, the lower the cost of money, you get asset appreciation. And so that's exactly what we've had. And so Michael is right on the money to be asking this type of question, which is, okay, so now we've exhausted that. Now that interest rates are coming back up to, 5, 6, 7%, are we going to see any growth? Now, the reality to that story is it depends on the location, because what we've always said is that longer term income growth is ultimately the driver of, and when I'm talking about ultimately, we're talking about 20, 30, 40 years of growth. So what we have seen is the instrument of interest rates, when they went down to those emergency levels, we saw this, and Tim reinforced it at last week's show, this incredible uplift in property valuations, which we're now giving some of that back. So that is the question. So when I look at that, I then say to myself, well, what is the RBA telling us about neutralised rates? What they're telling us about neutralised rates, that's at around 2.5%, so 250 basis points for the cash rate. So obviously right now the cash rates, as we go to air, is 260 basis points and may get into 300 plus basis points. So that is going to work out basically who has been swimming naked, and we're going to then sort of look at those economic centres and those drivers of economic growth that are going to increase our wages, and that wages story is going to be the next phase of growth that we're going to see. So like what we have seen, even though the most vulnerable areas have always been described as the higher end of the market, they are also the areas where income growth is the greatest, and that ultimately drives a flow of value. So if you think about mid-tier city rings and the outer areas, the greenfield areas, they are technically price takers based on affordability. So if the inner city areas don't grow, then it's a real struggle for the middle ring and then the outer ring property prices to grow. So I'm super confident of a population of 35 million people in this country by 2050. I'm super confident that all of those sort of professional jobs, we will continue to see good wages growth in those particular areas. The risk is always in those unskilled labour jobs and obviously automation and technology changes. So that will be challenging for that lower income area. But again, property is a product of human interest and human behaviour in the way in which we are proud of that property, and the location in which we live and the people that we want to mingle with in our tribes will always drive that story going forward. And if we are successful, if you just think about it in your own sense, if we are successful, how do we show that success? We talked about it a few weeks, Bryce, in terms of it wasn't greed. It was what was the other one we talked about? It was envy. It was envy so people have house envy. I mean, so what do? They make a beautiful home. And so they reinvest that money into the home, which ultimately ends up in the land value. So personally, I'm not worried about long-term growth in terms of those core markets. I am worried about markets that may not have economic drivers, because that you will be susceptible in those particular markets. But I think about the net wealth. I think about the $3 trillion worth of inheritance that's going to be passed on from the baby boomers down. So that wealth really doesn't go anywhere except for downstream into the next generation. So it's a combination of those things that are very, very powerful in terms of continuing to put pressure in those markets. And so, since the turn of, we became a federation, property prices have grown around that 5 to 6% range, and the better markets have grown in that sort of 6 to 7 to 8% range. I don't think that's going to change unless something material happens in terms of market intervention by governments.
I think it's a good point that you make around the inheritance too, Ben, which is a significant amount of money, because people, when they ask these questions, and rightly so, assume that the whole purchase price will be around lending. But going forward in the future, you might have access to a large cash deposit that comes through an inheritance, which means that the amount of lending that you need is lower, whilst the value of the property is still increasing. I also think on the demand side, if you think about the fact that we are a unique country where we don't build communities in the desert outside of the couple that we currently got. because we stay on these urban coastal rings where we're finding it very difficult to sprawl out from them. We even had the Premier on. Part of the conversation towards the back end of that conversation was, how do you release the supply and get the developers to be excited about it at the same time? So I think, the conversation we had prior to the pandemic was the Roaring 20s. That's obviously had a massive pause put on it. But now as immigration's coming back in, you're getting all these knowledge workers coming into Australia who have a higher propensity to earn above average income. So therefore they will, if they are getting into the lending game, they will be out. You want to chase around and see where those people want to live, because they'll actually be driving the value, plus the people already who live in Australia who have got those incomes that can increase. So I think the lesson here is, in the past, you've had the rising tide lifting all ships for the reasons we talked about in that first 20, Ben. But for a quick recap, we had organic income increasing because we went from one full-time income to over time 2 full-time incomes, and then 2 full-time professional incomes. And at the same time, organic expenses dropping through interest rates. So that meant the borrowing capacity was just fundamentally inflated for everyone, which meant that. So asset selection going forward is going to be the key here, and making sure that you understand where those people are going to be. So good question, Michael, but I don't see it in a case that the property prices will stagnate if you just look at it logically. If you've got all these people coming, we don't produce enough property quick enough, and the people, as a precedent to other cities around the world, we are still cheap compared to other big metropolises around the world. So it's not like we're setting new pioneering ground here on prices where everyone's going, oh, look at those prices in Australia. You only have to look at the television shows that highlight prices in New York and LA, and just, that's your starting point. So I'm with you, Ben. I don't have any fundamental concerns about growth still happening. It's just you need to be more selective than you ever have.
Bryce, can I double click on your initial point there in that section? It is absolutely critical, because what we're trying to say here is that generational wealth, or that ability to actually only borrow $1 million. So let me give you an example. If I borrow $1 million to buy a $1.2 million home, I borrow $1 million. But if I'm on a upswing in terms of the upgrading of the different property that I want to eventually live in, I might only have $1 million debt on a $3 million property, because I've been able to buy property and use that equity. And so obviously that's paid. So this is the point that we're making, whether that comes from an inheritance, whether that comes from stepping up on the property ladder. There's all of these moving parts. And what we've also got to remember is only 30% of us, or about 35% of us now, have debts against those properties. So that is why it's so fascinating in terms of a marketplace, because if we just look at the instrument of interest rates and we just look at the ability of wages growth and that to drive values in an early market, they make a big difference. But in an established long-term market, so you just need to look at London, you need to look at these markets that have been around for 500, 600 years, there is a lot of wealth in those areas, and there's a lot of property that's very tightly held in generational wealth between family to family. We're growing up. We're a very wealthy nation, Australia. We're very blessed. And as long as we keep competitive on the global scene, and we keep doing biotech, and we keep developing our knowledge centres in Australia, and we can compete on that global scale, then ultimately those incomes are going to keep coming into this nation, and also that that generational wealth is going to continue to put pressure on property prices as we go forward, because these blue chip locations, for every one property, there's more and more people who are trying to get into those blue chip inner areas over time. And so again, we're not saying that that's the only way you can invest, but if those blue chip areas don't move in a capital growth sense, then the middle ring ain't going to move, because the ripple effect just won't take shape. So that's why over the long term, I don't lose any sleep about the level of growth. But I will say, in terms of the ratio of growth, or the long-term capital growth returns, are probably going to be different in different locations on 100%. The back of the gross production that happens in that particular location.
If you haven't listened to last week's episode with Tim Lawless, there's a report. Go and listen to it, first of all. Secondly, there's a report that you can download. And I said it in the interview last week, Ben, and I'll say it again. There's this graph in there that talks about all of the milestones and all of the headlines of the day that could have given anyone in the moment, because if you just chop off the chart at that point in time and not see any of the future, you could have quite easily thought, that's it, price is done, we're cooked, it's going to flatten out here forever and a day. And then all of a sudden you see the overwhelming, with volatility, overwhelming trend has been up.
There might be 5 years of flat growth in the next 20 or 30. There might even be 2 years of negative returns. That's true too. But ultimately, the trend will be upwards because it's not just driven by wages and incomes. It's also driven by this generational wealth and this building on building on building on building and the productive use of land. Ultimately, that's where you'll see that ultimate value. Because at the end of the day, it is the land value that appreciates. It's not the dwelling that sits on top of it. But some people will look at a dwelling on top and its scarcity and its beauty. It's coming back to owner-occupier appeal. All of those things will ring true. It's called the Veblen Effect. If you haven't ever heard about it, it's an economic term. It basically, in some cases, Veblen means that the higher the value, the actual greater demand you get on that asset. Now, things like obviously rare art and those type of things, but you could argue, when you see properties like the $80 million transaction that just happened in Toorak recently and all of those $100 million, that is a Veblen effect, in terms of that is an asset that because of its scarcity, because of its uniqueness, Point Piper assets, those type of things. Now, that doesn't include all properties, but if you start to think about that concept that those people want to get into those areas for status, human interest, human behaviour stuff, that really does play out as well. And that's going to happen as in areas gentrify. It's not just happened in the blue chip areas, but it also happens in the gentrification areas where people see a trend, it's a vibe, a community, all of those things that are going to build that out. And that bodes well for reinvestment and regeneration of the properties. You only need to drive through these suburbs where they're knocking down 50-year-old houses and building, $2 million properties. That's all going to fall up in the land. That's all going to end up in the land value as more and more people regenerate those locations. And that bodes well for future growth as well.
And to reinforce the point you just made before, Ben, according to CoreLogic, they said we almost hit 10 trillion. It's probably come off a little bit, but let's just for the maths, 10 trillion in value for reso, and about 2.2 trillion in mortgages. So that's a 22% LVR currently right now. So that's kind of further reinforcing the point that the whole market is not sitting at 80% LVR. The whole market's sitting at 22%. Good one, Michael. I reckon a lot of people had the same question as you.
Yeah, terrific.
So that's a terrific question. Last one here, Ben, is from Karen. And it's a borrowing strategy question around what is the optimal review and what is the optimal outcome? So this will be a good one for you as the mortgage broker. Let's have a little listen.
Hi, Bryce and Ben. My name's Karen, and I have a question about refinancing a principal place of residence and investment properties. We currently have a line of credit on our principal place of residence. We use this line of credit to purchase 3 investment properties, and these 3 investment properties are all with different lenders. With the current interest rate rises and some of these loans coming off fixed interest, we are now wanting to refinance some of those. Our mortgage broker, this is my question for you, our mortgage broker is suggesting because of our age, which we are 51 and 52 respectively, and we have high disposable income because our children are over 18 and at uni, that we combine all of our loans into one big facility with AMP and have it split into various splits. So our home loan on P&I and then the various investment properties as interest only. I'm really concerned with this approach because it goes against everything that I've listened to in your podcast to date. And I would just be really interested to hear what you have to say on that approach. So basically the splits for the investment properties would be interest only and our principal place of residence P&I. And she's saying that this is the only way forward for us to be able to refinance the whole lot. Ideally, I'd like to keep the line of credit. I like the flexibility of it, and I'd like to keep the investment properties with loans separate to our home.
Karen, good question, Ben. There's a fair bit in that. And reviewing is a great idea, but it's also an interesting environment to be doing it in, right?
It's a very interesting environment it's a challenged environment at the moment. We've been talking about this in terms of obviously higher interest rates means higher servicing calculators and not as easy to move money around. Of course, Karen, we don't know your full situation, and obviously from a mortgage broking point of view, as a licensed broker, there's a best interest duty. There's a duty of care that needs to happen. So we can't give you specific personal advice in this particular circumstances. So we'll talk general about this particular piece. In terms of the AMP product, I'm pretty sure it's called sort of like an all-in-one, or the wealth all-in-one product. There's a product name for it, but it's not coming to me right now. But the principle here is AMP's backstory is that they were wealth advisory. They were a financial planning business that then became a bank, or they were a mutual society originally, but they did a lot of heavy lifting in financial planning. And so the idea of this all-in-one product, where effectively the bank takes all the security and then has one large facility of which they can then chop and change and do different splits. And that's not credit critical when you're adjusting some of those types of splits. I think it's called something like the wealth loan or something like that. So I sort of understand why the broker's sort of saying this is best for you and given your ages, but I wouldn't necessarily say that that's the only option here. I would be talking more around the line of credit might have given you that flexibility, but if that line of credit is drawn down, and I say this generally speaking, your line of credit is a higher cost loan. So the interest rate on that line of credit loan is high. When that loan is fully drawn, or when the maximum of that's drawn for, say, one loan split, you really don't need that to be a line of credit anymore. That could quite easily be switched over to an interest-only variable loan with a cheaper interest rate with an offset attached to it, where you can park any surplus money if you're getting that surplus money in. So I would say the benefit, Karen, of having such a thing, generally speaking, for the community, is that you're going to pay a higher cost on your money. Now, I'm not sure you need that. So if you still need a little buffer, in other words, a limit that you can draw up to in emergency circumstances, sure, split that off into a new line of credit, because if there's nothing drawn on it, it's really costing you nothing. But in terms of when you have used the equity in your home, to say service the 25% and you got the new loan at 80%, once you've actually used that money, separate that loan out and basically have it as an interest-only loan, because it's just going to be cheaper for our community if they're going to be doing that type of structure. So it's an interesting one. It's hard because we don't have all the facts in front of us in terms of, so I'm not going to dismiss the recommendation from their existing broker, because she has the privilege of all of the financial information in front of her to make that recommendation. So I'll never undermine any other professional who's made a recommendation based on the information they've got. But I will say, generally speaking, I too have a line of credit. I have it sitting there. But the moment I use a portion of that line of credit, I'm then back off to my broker, who is then restructuring that loan to a new split. And we're going to interest only over a 5-year period as part of that. And the final point around ages, yes, there might be some lenders who discriminate on age in terms of what facility that they can do, but there are 50 odd lenders out there in the marketplace that are looking to buy business. So that's not always the case. And as we are growing and living longer, the reality is that some people will be living and working in their 70s. And so if you're only in your 50s, 25-year loan terms should be a plausible opportunity for some, and some banks see it that way as well.
And for two people, for me, in the shadows of that age bracket, Ben, and you in that age bracket, it's hardly over the hill, are we? So it's there's still plenty of opportunity there for people to lend, make more wealth. And in this case, they have children off at uni, right? So disposable income is probably the highest they've ever had and probably ever will. So there's definitely opportunity there. So I think there's some good points there. I'm not a mortgage broker, so I'm not going to chime in too much other than to say that if you're feeling like that's not the right thing, maybe just a second opinion, Ben. If you just to satisfy your own sense of curiosity, make sure the person you're talking to is an investment savvy mortgage broker, because that matters. And then just compare the information that you get just to satisfy the curiosity. But as you said, I must admit, in the early days, Ben, I was addicted to the line of credit because I thought that gave me the better flexibility. But once you do understand that you have the opportunity to do a very similar thing, in fact, identical, by having a fully drawn loan that sits into your offset account, and then when you disperse the funds out at settlement, you're left with some over, that's effectively having the same opportunity to give you the liquidity and the flexibility that you're after. So maybe that might be something.
Well, and back in the good old days, Bryce, you actually could get a line of credit at the same rate you could get the variable loan at.
Yes.
So, I mean, the world has changed so much in the last sort of 12 years where we've got all of these extra, sort of premiums on different interest rates because of investment versus private use versus interest only versus P&I. I mean, yeah, the banks have got a tough job in trying to, keep profitability and keep their net interest margin healthy so their shareholders, are happy about the share price. So it's challenged on both ends, but there's not too many lenders out there now who will give a very competitive line of credit rate. So that's also what you've got to be thinking about as part of this story. But that's why, the vast majority of the work we do here is very much setting up these sort of what we call quasi lines of credit, which is a variable interest only rate with an offset. So the money gets parked in the offset and effectively there's no repayment due, because you're not using that money. So if you sort of get, let's say it's $100,000 for simple terms, the money's drawn down on a 5-year interest only period, the $100,000 goes straight into the offset account. So there's no interest being charged from net. So from day one, there's no interest being charged. And the interest rate is, 40, 50 basis points cheaper than the line of credit rate. So, when it is drawn down, the cost of money is cheaper. And we're really interested in keeping the cost of money as low as possible.
And the other thing, Karen, I could say to you is Ben's done a Beat the Bank series on video. So if you go to Ben, you'll have help me out with the URL here, moorr.com/.
Yeah, moorr.com.au/beat the banks.
Beat the banks. There we go. So
just one word, beat the banks.
Beat the banks. And Moorr is MOOR. All right, folks, that is another great show from our people, Ben. We've said it for a long, long time. Hearing the questions of the people at the coalface is wonderful. So a quick shout out to Janet, Adam, Michael, and also Karen. Thank you very much for contributing your questions. Start and Build course, reach out to us. Let us know where to send you access to that, and we will do that, folks. If you want to ask some of your questions, and they've never been more important than right now, go to thepropertycouch.com.au, and on the front homepage there is a little widget on the right-hand side. It's yellow. You can't miss it. Press the button, start recording, ask your question. I see them all, and if they are topical and they allow us to provide an answer that benefits the whole community, not just a very specific niche question, Ben, chances are we will read them out in a show very, very shortly. Hey, my life hack today, Ben, is, I know I give a lot of iPhone hacks. I think that makes sense because I'm an iPhone user, right? But I don't know if you knew this, Ben, but do you know how you can touch the screen? Remember the old days, the iPhone had a little home button. Now it's just full screen. Everything's just touching, right? I found this little hack that, so you can see this on my phone. I'll see if I can show you, and then we do it for... Yeah. So if I double tap the back, see how it opened my camera?
Ooh.
And if I triple tap the back of the phone, it'll automatically mute my phone.
And you've got a cover on your phone too.
You've got a cover on the phone as well.
That was
so most people don't realize that the body of the phone is pretty special too, not just the screen. So and there's actually a chance you didn't notice this. So the Apple logo on the rear of the iPhone is actually a button. So if you think about it, the entire back of the phone is the button. So what you do is you go to settings. Once you're there, go to accessibility. And then when you get there, select touch, and then select back tap. And then it gives you a whole bunch of options, right? And so you got two gesture options. One is you can double tap the back, and another one is you can triple tap the back. So you get to choose. When I double tap the back, because I'm constantly picking up my phone and you're trying to quickly get your camera right, just double tap the back and she opens up your camera, right? So it's just giving you a little hack. So for me, camera, and then on the triple tap I use for mute. But there's a whole range of options that you can actually choose, including Zoom, magnifier, cool shortcuts, open Safari, anything, right? So go and check that out. Now, for those of you that are Android users and you go, oh, here we go again, or if you've probably switched off at this point, you haven't listened, I'm sure there's something that you can do that's similar. Well,
why don't you look after that 30% who have Android, Bryce, and start doing a few of the Android hacks?
Because the life hacks are the ones that I use, mate. They're hard enough to provide one every week already, mate.
Well, that gives you a reason to go and provide for, those other members of our community. Anyway.
Oh, that's true.
There we
Yeah, that's
go.
one way to look at it. I'll just go, here's a hack that I've never used myself, but see if it works. Let me know.
Exactly.
Let me know. So there you go, mate. So what's making property news, Ben?
Oh, look, mate, I mean, I thought I'd just keep it light this week. We've had a few intensive weeks in terms of what's been happening out there. So I stumbled across this. Well, let's be honest, you stumbled across this story about the top 10 celeb investors. Hopefully my voice is going to make it through.
You're just about to make it, I reckon.
Isn't that interesting? You can listen to this whole show.
Been on the Source last night?
No, I didn't. You can listen to this whole show, and from the top to the bottom, you can hear me lose my voice. So these are the top 10 celebrity investors who are the most successful.
People were probably hoping that you could lose your voice every episode right at the top when you bang on about Collingwood. So maybe you could organise that.
Oh, I'll do my best. So these are, we'll try this again, the top 10 celebrity investors with the most successful investments. So let's go through them. So you've got Mark, is it Cuban? Now, I wouldn't really say he was a celebrity.
He said that, but he's got a television show, mate.
I know, he's
the owner of the Dallas Mavericks.
I get that.
He's in the front row, so only celebs sit in the front row.
Well, we went to see the Dallas Mavericks when we went over there, a couple of years ago. Anyway, but the other one, the next one's probably legit.
We weren't on the front row.
Jared Leto. So, and he's an actor, method actor, very, very good in terms of what he does.
He's incredible. Have you seen the movie House of Gucci?
No, I haven't seen that one.
He's in that, and you would never, unless you look at the credits, you'd never know that he was actually in it. But okay. Anyway, we digress.
No, good. Well, that's all good. Ashton Kutcher, and you've got Jay-Z.
Yeah,
I don't know Jay-Z, whose real name is.
You don't know who Jay-Z is?
I probably do. Is he the one married?
You know who Beyonce is?
Okay, yeah, I know them hanging around together. Yep, that's all good. I'm not a celebrity follower. You know what I mean? Like, I don't do celebrity.
No,
Drake. Although I this next one, Ryan Reynolds,
yes,
he bought this soccer team, and there's a documentary thing on Disney that I am watching.
Yes,
but anyway, that's a story for another day. Calvin Broadus, who's that? Anyone?
No, I must admit I don't know Calvin Broadus.
Yep. Anyone? Yeah. Anyway, Kevin Durant. Well, we know who KD is. He's a legend.
Mate, on a side, have you seen how he can handle the ball at 7 foot? He's incredible, like a point guard. There's a guy at the moment who's 7'4" from France that every team, and he can handle it like Kevin Durant. So every team is going to go 0-82 this next season. It's a tackathon just to get him. Have a look.
What's his name? Do we know his name?
He's a French. Sam asked me, my youngest, he said, "What's his name?" I can't remember it. So I just showed him the footage.
Someone in the socials tell us who it is. But I'm all into my basketball. So okay. So KD comes in number 8. The chain smokers. Yep. Who are they? No idea.
I don't know either.
Will Smith, it comes in at number 10.
Will Smith has to be a good investor now because he's probably not going to get a gig.
Wow. Put it this way, people will think twice. Now, unfortunately, no women in the top 10, but let's honourable mentions to the women. We're talking about Gwyneth Paltrow with a portfolio net worth of $782 million, Oprah Winfrey with a portfolio of $736 million US, Serena Williams, the great Serena Williams, 684. And Natalie Portman also has a 657. Now, I didn't do the amounts for the guys. Doesn't matter. The point being is what they're doing is they're getting cleverer about their distribution.
Getting what? Cleverer?
They're getting smarter about their distribution. And they're taking equity in these businesses as opposed to just selling their selling their advertising time, right? So,
well, the disclaimer here, Ben, is we don't love talking about rich people and rich and all that sort of stuff. Really. But the thing that caught my eye was, well, there's a bunch of people that do lots of boring stuff with their money as celebrities, but these people are actually going, well, I've got this incredible, blessed opportunity in my life, and I'm actually putting it towards something where I can grow what I've got rather than buy houses and then 10 years later be on one of those stories where did it all go? So.
Yes. Yeah. Well, Kim Kardashian also, just for a little shout out there, I mean, she's just set up a VC fund that just straight up is worth over $1 billion. Was
it her or a sister?
No, she's done it, I believe, in terms of partnered with a
look at us VC providing over there. New idea.
I mean, and she's also got this, is it Skims, the sort of shapewear clothing company that she's got as well. So that's worth about $3 billion. Yeah. Anyway, so there you go. In terms of celebrities who are not just using their talents as sports people or talents as actors, they are also investing to try and build their wealth.
There you go, folks. So there's a little bit of inspiration for you. But mate, a big show, 4 great questions.
Love the questions.
We love Q&A day. So hopefully that's given you, as a community, an opportunity to learn something and have a takeaway today that you can apply to your own situation, your own circumstances, your own portfolio. So it's always fun to riff it with you, mate. I think your voice is just going to hang in there for this very last thing I need from you today on this podcast. And it's simply this, mate. Until next week.
Knowledge is empowering, but only if you act on it.
Ooh, hung in there, mate. Well done. See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1. Because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. But folks, I want to encourage you again to go to thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.